Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, everyone, and welcome back to the CreditSights No More, Risk Better podcast. This is Winnie Cisar, Global Head of Strategy at CreditSights, and this is my first podcast of 2026. Might be a little bit rusty after the holiday season, but I'm going to try and get in the swing of things. And today I have a great guest to help me out with that. We have Matt Woodruff. He leads our research across aerospace and defense, airlines, aircraft leasing, and transportation. Matt, you kind of do a lot there. Great to have you.
Thank you so much. Yes, always seems to be adding, another sector to cover, but I'm happy to do it and really excited about 2026. Thanks so much for having me.
All right, let's be excited about 2026. I feel like there's been a lot of doom and gloom to start the year in terms of headlines. And on that, airlines, 2025 was bumpy, dare I say even turbulent. We had modest demand, higher costs, fuel saved earnings at the margin. What's the setup for 2026? Is it another kind of not great year?
Yeah, so I'm not expecting huge things from 2026. Just to quickly recap 2025, it definitely was a bumpy year. We started off the year, actually January was really solid. The airlines were saying, things are going extremely well. And then we got into tariff land, right? We got into Liberation Day tariffs, and that really put a damper on all kinds of demand, whether you're talking about government demand, you're talking about business demand and consumers really across the board. It kind of took a step down. And then really it took into midsummer. Really, the airlines saw things start to pick up a bit. And then, of course, when we got later into the year, we got into the government shutdown situation, which just brought another, bump in the road. And I think, at its peak, there's a couple weeks there where schedules were constricted, and there was about 6% of FAA mandated schedule declines at that period. So that was a difficult period, and then we got through that, and we kind of limped into the end of the year. So it was a bumpy year for sure. Overall though, as Winnie's well aware, very tight spread environment. And with airlines, having a extremely high probability to default, this is a pretty easy call to continue to be underperform on airlines. We do like the lessor sector, but again, we have a bit of a valuation issue there that keeps us kind of market perform. On the airline side, it's really still a bifurcation between two different areas for the airlines. You have the very successful airlines, the premium demand-driven airlines like United, and you have Delta. These airlines that have been extremely successful in the post-COVID period. And then, of course, the airlines that haven't been as successful have been the ultra-low-cost carriers. Really, the low end of consumer demand just has continued to struggle. So you're talking about carriers there like JetBlue, Spirit, and Frontier. Spirit, of course, having gone through its second bankruptcy in about a year's time. So it's been difficult, on those folks. From, overall volume perspective, last year was basically flat, or basically flat on travelers, which, that's pretty not great for the aviation industry. The aviation industry tends to grow pretty well over time. With the long time investment theme has been kind of a rising middle class leads to more demand. And of course, falling fares means more demand too, and more people are traveling. And I still think that's true on a global basis. But in the United States, we kind of slowed down quite a bit last year. Coming into this year, not expecting a ton of growth. So IATA is looking at 1.5% growth for North America, and that compares about 5% globally. So definitely relatively tepid demand. Another big thing that's been going on is on the supply side. I'd say in general for the airline industry, there's kind of been a hope that carriers would kind of rationalize some of the flying that they were doing, given the fare environment, which has been fairly weak, really going back to about 2024. It's been difficult. And really, we have not seen that on a big scale. We have seen is Spirit Airlines significantly lower their flying. So they're down about a third, and they've taken about half of their fleet offline. But outside of Spirit Airlines, it's just been a couple of small regional airlines that have reduced some of their flying. All the majors continue to increase their flying. So we really haven't seen that decrease in supply that I think everyone was kind of hoping for. Overall, just still kind of broad-based, difficult environment for pricing improvement outside of the premium segment, which continues to be pretty good. I know this is a point of debate, though, and you definitely have a lot of sell-side equity analysts out there that are much more bullish than I am as far as pricing is concerned. If pricing does turn around and gets, some significant tailwinds to it, that can definitely change 2026.
Yeah, it's so interesting, this kind of dislocation between equity, sell side people being a bit more bullish on pricing, and then consumer perception. When I go on and I
Mhm.
buy plane tickets, either if I'm booking something for work or if I'm, traveling out to Phoenix to see my parents, it all still feels so expensive despite this kind of weaker pricing environment. And then, the premium demand and the first class, I have pretty good status with American Airlines, and man, I am not getting my auto upgrades like I once did, and that is such a bummer.
It is, so it's an interesting point in that, you have the airlines have done a pretty good job of establishing these loyalty programs, which sounds like you're a part of an American, which is great. I'm sure
Mhm.
they love it. Um, but the problem is, when you have so much of your customer base of your
Mhm.
regular flyers that are part of that, kind of dilutes the experience. And
Mhm.
Delta Airlines CEO was on Bloomberg actually today talking about that, and he was getting a hard time about how crowded a lot of their spaces are, a lot of their lounges are. And it's
Mhm.
definitely true. When you have a lot of customers out there that are using that product, it tends to be diluted. I would say, the overall pricing environment, when I do look at pricing, very regularly. And there's a huge bifurcation, still between the back of the plane and the front of
Mhm.
the plane, and it's really only been growing over the last couple of years. So it sounds like, Winnie, you're probably sitting at least in the middle of the plane if you're paying a decent amount of money, probably not all the way in the back. I mean, there's a big bifurcation between those two, and continues to be the case. And I think it has a lot to do with the consumer as well. Your better off consumer is willing and able to pay for a lot of those upgrades. And on the low end of the economy, I think, we're seeing some difficulties still in kind of getting some of that demand going.
Yeah, absolutely. So, on the fuel side of things, last year for oil prices, we basically saw them go in a straight line down for the first half of the year. They kind of spiked again, and then another straight line down in the second half of the year. That was a bit of a tailwind for airlines. What do we think about 2026? Are we going to see that continue to be a benefit, or are there other cost pressures we should be keeping in mind?
Yeah, so we'll see. I feel like that's so like such a geopolitical kind of question, and so Venezuela for a while, everyone was thinking, oh, we're going to get a lot of extra oil supply, and that should push things down. And now we've got Iran, and so what if the Iran supply goes away? Of course, that'll push fuel up, so it can be super volatile. Overall, we think it's going to be supportive this year. We should still see improvements from a cost perspective on a per gallon basis, but not to the same degree that we saw last year. It's just not going to be as much of a tailwind. Overall, the story last year was really non-fuel costs. So labor's kind of the top of the list. You have many labor agreements were repriced lately that sent wages significantly higher, and that's not done. So this year, United's flight attendants still have to get done. They've been working on 2020 wage rates, and here it is 2026. So they're due for a substantial change in their wages. So this is still coming through, and you have other things like landing fees, a lot more expensive, and those are kind of driven by capital improvements on the airports. Maintenance, a lot more expensive, very hard to get into maintenance shops these days. And then all other kinds of operating costs have been, difficult as well as a proportion of revenue. All that stuff has been climbing. So, that combination of I talked about the kind of modest volume and kind of fading fuel tailwind, and then still kind of difficult overall expenses. We think margins are going to be, under pressure as well yet again this year, just like they were last year. And then, I would say maybe even more important than that is a potential problem with the loyalty program. So loyalty is hugely important for airlines like Delta, United, American, super important to cash flow. So Delta just reported yesterday, and they reported $3.8 billion of overall free cash flow for 2025. And of that $3.8 billion, $8.2 billion consisted of payments from American Express, which is their credit card partners. So as you know, credit card partners are kind of the biggest part of loyalty spend. And, there's been a lot going on lately with the future of credit card spending. And so one thing that happened late last year was a merchant settlement. This is still not quite resolved yet, but it's been an ongoing multi-year situation between retailers and Visa and MasterCard. And right now, the proposed settlement would allow retailers to actually differentiate as to which cards they take. So, for example, they may accept Visa, but they may not, they don't have to necessarily take Visa Infinite, which is, so Visa Infinite would be, the type of card that is used for a lot of these premium, airline cards. For example, MasterCard has their own version. It's called World Elite System. But basically, retailers would be able to choose it. Yeah, we'll take Visa, but we're not going to accept that 3% Visa Infinite fee because it's just way too much. We're only going to take basic Visa, which to them, maybe it costs them 2% or 1.5% or something like that. So they'll be able to differentiate from this. And given the fact that these credit cards ultimately, that 3% just goes back to the bank, and ultimately it goes back to spending on the airlines for these points and miles. So that is the very bedrock of the kind of modern, airline financial profitability that we have today is built on this stuff. So there's stuff going on here. It's super important to watch this. And I would say for 2026, this is my number one watch item. We need to have a higher degree of certainty with what's going on with credit cards. I'm sure you heard the 10%, kind of cap that's been proposed as well by the president on credit cards. So that's another kind of wrinkle to this. Doesn't really directly affect the financing the economics of the loyalty program necessarily, but certainly affects the economics for the banks and their willingness to lend. So there's a lot of questions going on right now with where loyalty is going. And if, I hate to take a doomsday scenario, and I definitely wouldn't call this a base case scenario, but if the loyalty programs were to, completely go away or materially change their economics, it would result in a significant upward pressure on fares, and of course that would push demand down. So, this is a very difficult situation, one to watch here in 2026.
Yeah, that seems so challenging, especially as the perception of the benefit around these loyalty programs has been diluted, and then you have these incremental pressures. This also just highlights to me that every company now is either a financials company or a technology company. There's nothing in between anymore at this point, it feels like. And that includes airlines. So let's talk a little bit about international travel, because that was such a story, especially in 2022 and 2023. We had rising interest rates and inflation, but international travel was absolutely booming. Now, to start the year, there's been a lot of headlines around dollar weakening and the trajectory of the dollar, which was very much on a downward spiral for all of 2025. How do we think about international travel? How does dollar weakness factor in?
Yeah, so it was definitely, very weak last year in 2025. And of course, when you have a weaker dollar, that does affect the affordability when you go overseas for the US consumer. Luckily, this has been a segment for the US airlines that has been fairly resilient, but we definitely saw that weaker dollar. Despite that weaker dollar in 2025, US outbound travel, so US travelers going overseas, was still up 3%. So it's been resilient despite the fact that we have that weaker dollar. Unfortunately, on the flip side of that has been, well, typically a weaker dollar would also mean you'd get a lot more people coming here. And unfortunately, we did not see that last year. So inbound travelers into the United States were actually down 4%, which is not what you want to see. Presumably, this is due to the political environment. I know in a recent vacation that I went on, I ran into some Canadian some Canada folks, and they talked a little bit about the political situation, how they were kind of avoiding the U.S. travel in the near term, despite the fact that obviously it's a lot shorter plane ride for them to go to the U.S. than it is to Costa Rica, for example, or Mexico. So that has been affecting things. Another thing to note, just kind of overall, as far as areas of weakness, kind of outside of the dollar, is just areas of the country that have been weak. And so Las Vegas has been, extremely weak lately. And then also Florida has seen a little bit of weakness as well. And airlines are responding to that. And so in the first quarter, capacity to Las Vegas, number of seats to Las Vegas is actually going to be down 8%, which is a big number. A lot of that has to do with Spirit. Spirit's almost completely pulling out of that market. But really, a lot of different airlines are pulling their Las Vegas flying down. And then another thing has been surprisingly weak is South Florida. And I'm not entirely sure why this is, but maybe it has a lot to do with the fact that kind of post-COVID, you had a lot of travel going on down there. Maybe folks kind of got their fill. Maybe everyone kind of bought their homes and then maybe they stopped using it for a while. I don't know, but that market has been weak as well. That's something to watch, here in 2026, in addition to the dollar.
Yeah, I mean, South Florida, it feels like there could be a number of different things. Either that kind of, it used to be that the work from home really carried into extended weekend trips and things like that. And that seems to be definitely shifting and evolving. And then we also have, immigration and population changes, which could be another big thing there as well.
Very
Now, I
true.
know that M&A has been very topical in the airline sector, Spirit Frontier, but maybe a little bit out of left field. We had the Allegiant Sun Country transaction announced. What
Yeah.
does that even mean? Have you ever flown on these carriers?
I have not actually. So Sun Country, for those of us that live in Minneapolis, have surely flown on Sun Country. Sun Country is the number two airline there. They are primarily a leisure airline, and then you've got Allegiant. Allegiant is acquiring Sun Country, and Allegiant is kind of sprinkled throughout the Midwest. And both of these are kind of leisure focused airlines, and both have kind of they're extremely profitable, and they're able to be extremely profitable despite the fact that they're ultra low cost carriers because they're super picky about when they fly. So Tuesdays and Wednesdays for example, are pretty low demand days, and they just don't fly. If they don't think there's going to be demand there, they don't bother. In contrast to some other carriers like Frontier and Spirit that will continue to fly on those days. So because they're so picky about when they fly, and historically they've had really low costs as well, that has enabled them to be profitable, which is unusual for the ultra low cost carriers in this environment. But overall, this transaction is not a big deal. Unfortunately, it won't pare back a lot of supply. This is the ninth and the 13th largest passenger airlines in the U.S. And then combined, they'll still be the ninth largest, and they'll be slightly below Spirit in terms of the amount of flying that they do. They both have a fair amount of charter business, and then also Sun Country flies for Amazon. They fly packages for Amazon as well, and that will bring like their total revenue somewhere close to the Frontier airline size. But overall, unfortunately not going to be a big impact to supply, but both are profitable and they should continue to remain so. It is interesting that both these companies have been under pressure lately, and both have significantly reduced their flying here for the first quarter. Those markets that I talked about earlier in terms of the weak ones, Las Vegas and South Florida, they're pretty big there. And so they have definitely dialed back some of their flying, and maybe that's why they eventually got together. The CEO of Sun Country actually used to work at Allegiant, so there is some kind of connection there. And like I said, the business models are pretty similar. So I think the combination makes sense, but just not going to be a huge needle mover for the industry overall. You mentioned the Frontier Spirit combination. That's the one everyone's waiting for. Of course, Frontier Spirit had a deal, and then JetBlue kind of stepped in there, and they were not allowed to do so. The DOJ at the time decided that would be anti-competitive for them to combine, and so that kind of got denied. And since then, both JetBlue and Spirit have just had a really tough time. But with Spirit, really running out of money. Spirit is very, very low. Their bank account right now is running on empty. And so creditors are really kind of deciding right now what they want to do, whether they want to continue to fund Spirit, turn their reorganization into potentially a Chapter 7 situation, or will they be able to get a deal done with Frontier? I'm of the view that they will get a deal done, but we need this deal done now because they're running out of money, and I'm sure that all the folks involved there are not super willing to lend, a lot more to this situation. So stay tuned. This will be interesting to watch.
Yeah, I definitely will. I mean, when you have a company that's filed twice in just a year's time, that is definitely the definition of, throwing good money after bad if they're trying to raise more capital. So we'll be definitely looking for a deal. I don't think I realized that there were 13 air carriers in the US. If you had asked me to write them all down, I would have failed that quiz miserably. And I do think there's an opportunity for a CreditSights due diligence trip to Las Vegas flying Sun Country or Allegiant. Maybe we'll take Dave Bussey. He can check out the casinos. We could have a blast.
Absolutely. I think we should get Dave to set this up for us. Let's do it.
I really think, I'll set it up. I will run with that. All right. So let's talk a little bit about the supply side and lessors from an actual airplane perspective. This is a little bit of cognitive dissonance for me because I'm hearing, there's a bit of an overcapacity issue in terms of seats. But we have had these like OEM production issues. And so there's been that tightness. So how are we thinking about the supply chain side of things on OEMs? Where is this going to kind of impact the airline industry, and how are we thinking about Boeing and Airbus in that context?
Yeah, so I cover the North American airlines, and in terms of too much supply, too many seats out there, that has largely been a North American thing. Elsewhere in the world, there's not enough planes out there, and so there's still a lot of demand, ton of demand. And in terms of pricing, I mentioned the kind of the weak pricing environment. Europe is actually seeing positive price, so it's not terrible oversupply situation everywhere. And on a global basis, there's certainly a lot of aircraft to be filled. I was just looking at kind of long-term demand trends and where it comes from, and a lot of what I see is about 1,500 units a year. In terms of base demand, just replacement demand. And really, we're just kind of scratching on the door of that right now, as far as what Airbus and Boeing are starting to produce. So we're getting back to where we need to be, and supply chains are definitely healing. But we're having issues still. The issues are engines and interiors right now. So Boeing and Airbus are definitely ramping up this year. In terms of what is really needed, at this point, it's wide bodies. Wide body lease rates and asset values are really increasing pretty significantly. And that has to do with the production level of wide bodies, which are significantly below pre-pandemic levels. So for 2025, Airbus actually was able to produce a record number of narrow bodies. So they hit that record, which is great. They're way ahead of Boeing. Boeing, unfortunately, even in 2026, they won't be able to get to a record level of overall. But they're on their way. But as far as wide bodies are still, way, way below prior peaks. So that's the strength that we see right now. And we think that's pretty supportive for lessors into 2026 in terms of that, lack of wide body supply. Narrow bodies are fine though. They're not. It's not a great situation in terms of excess aircraft out there that we see, relatively stable. situation for narrow bodies, which of course is by far, the biggest amount of assets that are out there today.
So a follow-up there on the aircraft lessors, which do make up, a pretty good chunk of the IG market. How are you thinking about some of the factors, lease rates, residual values, funding in 2026? What do we think about, the sale leaseback dynamic, and who's going to benefit? Who's best positioned?
Yeah, so lease rate factors should stay firm, for the reasons that I mentioned, still some tight overall global supply and still the wide bodies, looking at the best in terms of constrained delivery slots. For as far as residuals are concerned, should be pretty solid. And we're actually seeing really, really large increases in residuals of last generation aircraft, which is pretty unusual, like this late into a cycle. So the current generation of aircraft have been produced for about 14 years already. So this late into a new production cycle to see, last generation of aircraft seeing pretty significant values come up kind of shows that there's still, kind of an underlying demand there, demand in excess of supply. So that's definitely still healthy. As far as funding is concerned, it's really just a race to the lowest cost of capital. And so all these companies are getting bigger. They're all kind of acquiring each other. AirCap and Avalon, have really, really good access to the unsecured markets at this point. They fund at pretty, significantly, pretty low spread levels really overall. So they have an advantage in that regard. As far as, like you mentioned, sale leasebacks, those were huge in the 2020 and 2021 timeframe as everyone is kind of looking for liquidity. They have come down pretty significantly, but we think that they should start, ramping up yet again in terms of the number of transactions in there. Overall, though, we like the large lessors right now. Again, you're not getting paid too much to go down in quality. AirCap is kind of the top of our lessor list. And our least preferred would be the narrow body only kind of type of operations. And interestingly, if you speak to a lot of lessors, they would say, well, there's a lot of risk in the wide body from a, kind of a longer term perspective. But what we see is, the wide body, asset values are increasing so rapidly that we think, from a current kind of book value and lease rate perspective and overall spreads, that's where the upside is. So we like the large, diverse ones. AirCap's a good one. Consolidation, will continue absolutely in this space. And last year the big one was Air Lease got chopped up. With the portfolio heading over to SMBC Aviation, and then kind of the base, or sorry, the order book portfolio heading over to SMBC Aviation, and the existing portfolio itself is actually being taken over this year by a consortium of investors. SMBC Aviation is also involved with that. Sumitomo is leading that group. Brookfield and Apollo are also involved in there. So there will be a pretty decent sized deal related to that. So watch out for that in 2026. And, we think there'll be definitely more consolidation to come. The whole industry has kind of moved from being US centric to, Europe centric. Now it's moving out towards Asia. So we do think, a lot of buyers out of Asia, it makes sense, as they have funding cost advantages in that region. We think that'll continue.
Yeah, so I'm going to move into the world of defense. I feel like we've covered a lot in the world of aviation, aircraft lessors, and with the headlines to start the year, we have what's going on in Venezuela, we have headlines related to Greenland. How are we thinking about defense budgets? Seems like geopolitical is going to be at the top of everyone's radar. Is that good for your defense coverage?
Yeah, absolutely. I mean, this is an incredible environment from a demand perspective, right? Like, so just this week, Trump was tweeting out about a $1.5 trillion 2027 budget proposal, which would be up from 1 trillion, this year. And even the 1 trillion this year was up 13%. So the numbers that are being thrown out there are absolutely incredible. That is hugely positive for all of our defense primes, of course. We do need to keep an eye on structure, though. And so one of the things that has happened recently is the government, and this is something that the administration has talked about doing but never done until now. The U.S. government is actually proposing taking a stake in a spinoff of a company from L3 Harris, their missile business. Which in and of itself is fine. The company will, take a preferred investment, which will ultimately get automatically converted into common stock. But we really need to watch these types of deals, from a credit perspective, in terms of how does it end up reshaping the stack, and how does it end up reshaping, where the debt is. Will there be significant debt at these kind of subsidiaries? This is kind of a new, risk that's kind of come up really recently in the last week or so. So we're concerned about, how the credit it will be structured post some of these deals, but overall from a demand perspective, absolutely crazy wild, very, very good. So we've been thinking about kind of the end of the Russia-Ukraine conflict as being, potentially, bad thing, but given everything that's going on, bad thing for demand, I should say, great thing, from a humanitarian perspective, and absolutely, best wishes to a quick resolution of that conflict. But we were thinking that, maybe Europe takes their foot off the pedal from a weapons demand perspective, if that were to happen. But really, given everything that's going on here in the U.S., we think it's going to be a super, super positive environment, well into the next administration. So pretty solid there. There's a lot going on with how contracts are being structured as well. The idea the current administration wants to make things, happen a lot more rapidly is the bottom line, and they want a significant amount of investment in the sector. And the other thing that's happened lately is a review that the president has just started. So he sent out an executive order in the last couple of days saying there will be a review of all the contractors out there, and any contractor that is not, effectively performing on their contracts will be put on the naughty list. And when you're on the naughty list, you cannot do, according to him, share repurchases or dividends. So, sounds like a pretty credit-friendly thing. We'll see how it works in practice. So it's overall, pretty positive environment.
Yeah, I mean, that seems in a sector that could theoretically have some maybe negative credit catalysts from, oh, this perception of strong earnings and growth, and maybe we're going to reallocate that cash flow to equity holders. Very, very credit positive overall. So where are we going to, have our top picks for the defense space?
Yeah. So with the kind of compressed spread environment, it's really, I think, nice time to focus on the very best credits in the space. It'll benefit from all this stuff. You have Lockheed Martin, which is a mid-A prime. It's actually trading wider than some of its A-rated peers like GE and GD. Really, this is one that as long as they continue to execute on their portfolio, we should see some compression that should bring them closer to GE and GD levels. They have nice spread pickup relative to those guys today. Another one that we like is Northrop Grumman, outperformed there. That's a rising A story. They already have one A rating. We think they'll get two more by the end of the year. And the long end is very attractively priced. We think it's relative to similarly rated peers. And there's a lot of strong program support there as well. B-21, Sentinel, space, missile systems, a lot going on there. And then we also have Howmet, which is another rising to A story from BBB Plus. Multiple tailwinds here: commercial aero, defense, industrial gas turbines tied to data center growth. This is the one that we've liked for a while. We've kind of rode it from double B. Remember, these guys inherited the stack from Alcoa, and they've just paid down debt. Leverage has come down all the way to 1.6 times. They announced an acquisition, which they announced an acquisition of CAM from Stanley Black & Decker. And as a result of that, we think leverage is going to go to about 2.5 times from the 1.6 they're at right now. We think within a year they'll be back to 1.6. So we think we'll get those upgrades, late into 2026 or into 2027 into the A category for that one. As far as other ones, Boeing, of course, is the big one still. Boeing has stabilized their ratings at low BBB, which was great. We think
They
a
did
lot.
it.
Yeah, right. we declared victory on this one, in 2025, late in the year. This is, been a pretty good story, one best performer, in the sector last year that we kind of rode. But later in the year, the spreads kind of reached a point where we kind of felt like there's not a lot tighter that it could go. It's already kind of inside of the triple B industrials curve. So where can we really go from here? There's a few things going on with the company overall moving in the right direction, but there's definitely cash flow risk related to some of their development programs that we're going to be watching. Because of that risk, we think they're going to keep a high cash balance in the near term, and we think that'll limit bond tenders. In 2026, they're going to pay down $8 billion of debt, which is a huge number. And we actually ran a poll on LinkedIn, and we kind of asked folks where do you think that money is going to go, and it was kind of an interesting answer. It was split across the board. I think it was 1/3 thought it was going to be reinvested in Boeing, 1/3 was going to be reinvested in aerospace and defense, and I think we had maybe 22% in technology, and the rest was just kind of other. So it's kind of all over the board. So overall, though, this is a credit that's getting better. It's just from a spread perspective, where are we really going to go here? So we have a market perform on Boeing at this point.
Yeah, I think that the out of Boeing into Oracle trade, that could be very interesting from a kind of thematic perspective, and some of the conversations that we've had around ratings downgrades and cash flow and all of those things. All right, so we've covered planes. Let's cover trains, shall we? We can do a kind of a quick pass there on transportation. And this is one of the places that we are a little bit more constructive, especially on the rails. What should we be listening to, watching for in 2026?
Yeah. So, the rails have had a really nice environment, despite a kind of an overall difficult picture on the transportation side. Really, the big thing for credit is the UNP, the Union Pacific, and the Norfolk Southern merger. This could be, it's hard to believe, but this could be the first time we have a truly national railway in the United States. They have announced a potential merger. The shareholders have already approved this. And at this point, we're waiting for Surface Transportation Board approval. There's a lot of things that need to happen with the Surface Transportation Board. And probably, the biggest thing is kind of, going through and doing an environmental check on this merger. And what that involves is it involves going to every single rail crossing and figuring out, okay, if we allow this merger, how is that going to affect traffic? How is it going to affect the environment here? There's a lot of work that needs to be done. They also make decisions on trackage rights and that sort of thing, and how are the remaining railroads going to have access to these to the combined UNP Norfolk Southern network, all that kind of stuff. So there's a lot to do, and they expect early 2027 close, which I think it just seems like super aggressive still. So we're thinking late 2027, if not into 2028. So I think it's going to take a while. The nice thing from a credit perspective is both Union Pacific and Norfolk Southern are kind of deleveraging in advance of this event. So UNP plans to pay down debt and stay out of the bond market, which is unusual for them. They usually issue every year. Sometimes it's twice a year. And then Norfolk Southern, same deal. They have maturities every year. Typically, they're in the market every year, but they're going to be paying down debt, kind of near term. Norfolk Southern has some operational issues to work through, but overall, this is already a sector that we think was going to A ratings anyway. And if you make these kind of monster, large, organizations like a Union Pacific, Norfolk Southern would be, we think it definitely solidifies those A ratings for them, and then potentially the rest of the sector as well.
Yeah, it's rails are somewhat close to my heart. Growing up on a Burlington Northern Santa Fe line, my high school was right on it. So, when we had to go to friends on the north side of the line, being stuck in that crossing and waiting for those long, long trains to go through was always so annoying. But it seems like there could be some strategic optionality here for CSX and BNSF.
Yeah, yeah. And so, yeah, I mean, I hear you on the waiting for trains thing, and this is why the government takes this seriously. The Surface Transportation Board looks at this hard. I can say that, I'm sitting here in the suburbs of Chicago. The combination of Canadian Pacific along with Kansas City Southern has definitely affected me personally. I definitely wait a lot longer at the railroad crossing by me that is a Canadian Pacific one as a result of that. So it's something that they take a hard look at. From a CSX perspective and BNSF, they're kind of the other two partners, right? So CSX is the other Eastern Railroad, BNSF is the other Western Railroad. And they have been kind of reluctant to combine. So far, CSX has kind of not indicated that they're willing to do it, and BNSF has been even more vocal, saying that they have no interest in combining. But you could see a situation where if UNP and Norfolk Southern are successful, in getting past the Surface Transportation Board, you could see a situation where those two are looking to combine as well. I'd almost call it, a likely scenario. But until then, this is, quite a bit down the line. We don't think this is going to be approved until late 2027 at least. So we have a little while to think about it. But overall, for the sector, it's definitely going to be a much lower issuance sector moving forward. So positive technicals there. And even if the transportation market is kind of a little bit shaky, it should be a very positive environment for credit.
All right. We love to hear a positive environment for credit, especially as we have a number of other sectors who seem to be going the opposite direction for 2026. So Matt, just to wrap things up, all right, we talked about airlines. We still have that big bifurcation between the premium demand being pretty okay, while we have those lower cost carriers facing some significant headwinds still. On the aircraft lessor space, not a bad environment at all. And we have to keep in mind that the United States is not the only air travel environment, and international globally is pretty good still. Defense spending will be really interesting to just see how this balance between momentum and, do we have potential upgrades? Do we have any sort of pushback on this share buyback issue that President Trump has introduced? And then the outlook for M&A in the rails and transportation space. Did I miss anything big? What's your favorite mode of travel?
Favorite mode of travel?
You a cruise guy?
No, I've actually never taken a cruise. Cruise is on my list. So
Okay,
I was trying to get my family on board with a cruise, and I got outvoted.
really?
Yes, they were pro Mexico Beach, and not so much on the cruise situation. I'd say probably flying, is my favorite, but I'm a stickler for direct flights. Direct flights are key. Which sitting from Chicago here is actually it's very accessible. We can get a lot of places directly. So
Yeah, it's true. I only live in cities with direct flights. I've been in Chicago, I've been in Atlanta, now I'm in Charlotte. I don't think that I could move to Sheboygan for a wide range of reasons. Not
right.
to hate on our listeners in the Wisconsin area, but I need my direct flights.
They're getting a lot of hate lately for whether it's us or the Chicago. I don't know if you saw the Bears coach. He was pretty. He had some opinions about the Packers after that Packers Bears game. So
I'll have to ask my 6-year-old. He's much more up on the ball sports than I am. I'm sure he's in the know. All right, Matt, thank you for all the insights. I always really like chatting with you. Your coverage of Boeing has been excellent, and you do cover so many interesting subsectors. So I hope that everybody listening enjoyed it as well. Thank you for joining us today. We'll, of course, be back with more sector updates over the course of 2026. We have some autos, Euro real estate on tap, and thank you for joining.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.